This is what happens when you don't understand what the market has done previously. You completely ignored the swing points, and you've bought a downtrend when the market already told you what's coming, but you missed it. By just looking at what this market's swing levels are forming, you should be able to identify what trend the market has followed. This helps us in knowing with a higher accuracy what would be the most probable direction it is going. For example, we've seen here on the left, an increasing market formed with higher highs and higher lows. So it's essentially just an uptrend. So during these days, what we should be doing is waiting for the market to pull back into the previous low, so we can look for buying opportunities to take the market into a higher high. This happened multiple times. It's the most simple approach of just buying pullbacks in an uptrend. But if you keep doing this forever, well, eventually the market will have to turn bearish as well. What comes next? The market trying to push into the highs, but failing, not having enough strength. So before we've had an uptrend, and because we've now broken the past low, we no longer are in an uptrend, because it doesn't respect the structural rules of a higher low. Here, we're having a lower low instead. It's really mostly about identifying the swing points, as they're what decides the trend the market is following, and we do nothing but just have patience and simply just following the trend. So now that we've got a market structure shift, the swing points reverse, the market now having pullbacks with the lower highs, which are there mostly to fill a supply, a resistance or a bearish imbalance, just to reject back down, with the lower low forming a break of structure on this time frame. After a bearish break of the previous swing point, a pullback will often form, similar to what we've seen here, where we've had the trend shift, and then we got a pullback to the upside that later faded down. It's what we should be expecting to happen again. The pullback filling a supply or resistance, so the market can later continue the downtrend. Now, of course, this won't keep happening forever, because we will eventually see a reversal once again. But trying to predict the exact moment of a reversal is a lot harder than just following what the trend is already printing on the chart. So as I said, because of the last break of structure, the market has a high chance of reversing to the upside in form of a pullback. The pullback usually ends up on a supply or resistance, so we need to identify a supply or resistance near this range, which is basically the most recent price action, being a pullback here, followed with a downside break. Now expecting once again a similar type of price action, the supply is identified as the last bullish candle before the downside impulse started to happen. That's very simple to identify in this chart. That's this candle right here. So the supply is taken from the whole candle, including the wicks. The price is approaching the supply, and when it's getting closer, we want to refine this supply by lowering down time frames so we can see the exact moment the supply will fill. The time frame you enter doesn't matter that much. It doesn't need to be that specific as long as it's lower than the initial time frame. In this case, I've chosen the 1 hour chart.